Hello, everyone, and welcome back to Continuum TV. I am your host, Christina Bruhan. We're going to continue our deep dive into regulatory clarity for digital assets. I'm really excited and hope that you are all enjoying your time with us at LA Tech Week. And we are going to be introducing you to former CFTC Chairman Chris Giancarlo and also Heidi Lehmann from Ligo Partners. Appreciate that so much. Since we're here to talk about commodities in particular, Heidi, do you have anything in your portfolio that you're particularly excited about the revolution in commodities? And I will start the list and we'll let you finish. But data as a commodity is something I've waited my whole life to see, as well as these like single carbon layers that are happening, as well as the space economy. Put a science lab up in space and see what happens to a bunch of stuff. All of these are like new commodities. Plus, real estate is kind of being revisited as a commodity, and tribal lands are definitely being revisited as commodities. Everything that makes the world go round, in our humble opinion at Continuum, ties back to some kind of commodity, whether it is attention or eyeballs. Those are all things that can kind of be quantified now. So I'm curious your ideas around the new commodity sector that you're particularly excited about. You get to see more of the world than the rest of us do.
I mean, I agree with you. I just think the fractional ownership real estate is certainly something that we're paying a lot of attention to. I think energy, carbon credit markets is something that we're paying a lot of attention to. And I think anything with space, space tech, defense tech, that is a highly investable sector. Surveillance in space, it feels like, every country's investing in that very, very quickly. So that's something that we've got a lot of, thought leadership and investment. So Ligo's made about, I think, $500 million of investment across 80 companies since 2022. And the majority of those where it's been very large checks, a lot of it's been space tech. So again, private companies, but we're definitely seeing, just like you suggested, real estate. I think energy is a close runner-up, healthcare to some degree, and then defense and space tech.
Let me just actually add another commodity, a new commodity to that. In 2015, my former U.S. government agency, the CFTC, declared Bitcoin to be a commodity under CFTC jurisdiction. It's perhaps one of the most exciting new commodities. It's the world's first digital commodity. And just judging by the success of the Bitcoin ETF, the last ETF to have anything even close to that level of retail excitement, retail and institutional excitement, was the gold ETF. But it was only a fraction of the amount of capital that went into the first Bitcoin ETF just a few months ago. We're seeing digital commodities, whether it be Bitcoin or Ethereum or perhaps even XRP, gain a huge following globally, and the mining of those commodities, the digital mining of those commodities, be a very important economic activity. One other point about that: throughout human history, most of the world's currencies have been based upon ultimately a commodity, whether that be precious metal, but also tied to agricultural interests. Even the United States, which was on a gold standard for a long time. Many people argue it remained on a commodity standard, but an oil standard over the last several decades. It's not a far-fetched belief to think that in the future, commodities will also be the currencies will also be once again based upon commodities, but those commodities might be digital commodities like Bitcoin and Ethereum and others.
So that opens up two potential doors of path here. We're going to let you choose your own adventure. Would you rather talk about the differences around a commodity versus a security, around why an ETF is important as a financial asset, and why a Bitcoin ETF is very different than an Ethereum ETF, which is different than a Solana ETF? Or we can go down the other path of asset-backed digital assets and stable coins and the foundation of the banking infrastructure. Which two would you prefer?
I'm gonna pass those both to Chris. Because I do not he's there. That is not my expertise. I'm definitely learning, so I can chime in on things I've learned certainly, but I'm a student. So I
Sure.
pass it over to Chris.
So I'll begin by just sort of talking about what's the difference between a security and a commodity, or a digital security, digital commodity, and then we could talk a little bit about how they're regulated here in the United States and around the world, and why those distinctions matter. A commodity historically had been something that came out of the ground, whether that's a precious metal or wheat or corn, or other naturally occurring commodities. We have subsequently, most in the late 20th century on into the 21st century, broaden that definition to include things that are man-made, such as data, such as energy, electrical power, or refined things that come out of the grass, like gasoline. And now with the birth of Bitcoin, the notion of digital commodities. A security is a version of a commodity, but where its value is not inherent, it's actually man-made. The issuer of a security is involved in a capital formation exercise in order to raise capital for an enterprise, and the success of that enterprise will add value to that security. That's very different than a commodity. The value is inherent. You might refine it, but essentially it's inherent to the thing itself, as opposed to a security that the value is added through human activity. A smart business model, a smart sales program, whatever it may be, will add value to that. Now, that distinction is one that's a natural distinction. But in the United States, uniquely amongst the world's developed economies, we choose to regulate them through different agencies. In the United States, capital formation instruments are regulated by the Securities Exchange Commission, whereas natural occurring commodities and the derivatives on them are regulated by a separate agency, the CFTC. In most major economies, they're regulated by the same agency. Now, I'm not there, when I was in business, I was not a big fan of that distinction. Since I've been in government, I am a fan of it. I think it actually reflects the founders' wish that our agencies be decentralized and therefore compete with one another. And I think the competition between the CFTC and the SEC has been relatively healthy. And if anything else, I'd say the fact that the United States has the world's deepest and most liquid securities markets and commodities markets by a factor of 10 or so is proof that at least our system works and has been historically successful for us here in the United States. When it comes to the development of digital securities, however, we are, I think, behind, and I think we've fallen behind in the last few years in taking that market structure and that regulatory structure and keeping pace with the pace of innovation. We've got to do a better job. I think regulators have to do a better job of clarifying where, when it comes to that distinction between digital securities and digital commodities, which are which when it comes to the various layer one protocols that innovators are developing. We want those innovators to innovate. We want them to develop them here, and we don't want them to be confused as to where they fall on the regulatory line. I think our American regulators need to do justice to American innovation by keeping pace with it and not allowing uncertainty to limit the level of innovation taking place here and to force it offshore.
Well said. I'm going to take a quick moment to plug Chris's book, CryptoDad. If you haven't read it, please go read it. There we go. This is it. So this is a book I would recommend to every regulator, every person, member at Continuum that's building with blockchain and AI. It certainly reiterates the data points I've been trying to stress to you guys, that there are big evaluators at the top. They're called the CFTC and the SEC. They have data points. So I'd also recommend to folks that are trying to get a handle on what is this industry. read it, and you'll either come out of it feeling that you have a really good grasp on how the world's finance and commerce and policy making works, or you'll be down with the rest of us going, Chris, how does this stuff work? And how can I build? My goal, as everyone knows, I want to build a checkpoint system. I want to build a PMO that can get people to an SEC no action letter, that can get people into global capital markets and being recognized as either a real player in commerce or not a real player. And that becomes a distressed asset that goes all the way up the chain to someone else, right? The world is in a brand new moment of history right now, and right now, and right now. And we don't have the data that is going to allow us to predict how to handle the next decade. And so Continuum's thesis is, let's gather the data. That's our revolutionary concept, is let's use AI and these node systems that allow for experts to say, I'm an expert in that thing. So Chris, if you were to sum up your expertise that led to CryptoDad and led to the Obama administration CFTC versus the Trump administration CFTC, and the policy making of how the real world works. Chris, what would you say to anyone who is looking to lead in U.S. policy regulations and digital assets as we come up into a very interesting election year?
Well, there's a great Italian word that I love very much. It's coraggio. It means courage. Regulators need to develop a degree of courage to advance this innovation. Unfortunately, Washington politics doesn't reward courage, but that's what it's going to take. Let me just tell a little story as to how I came to this, which I think helps explain why I think this innovation is exactly as big, Christina, as you describe it to be. My background, I practiced law for 16 years, and then I went into business, and I built a company on Wall Street that used wide area network technology to create a global platform for the execution and trading of a type of complex financial product called the credit default swap. Credit default swap is basically a kind of insurance against a debt issuer defaulting on their debt. And the reason why it's not insurance is because, unlike insurance, it can be traded over and over again. You can't take out a policy against something, and then when you decide you don't want it anymore, sell it to somebody else, and somebody else can sell it to somebody else. You basically have to close the policy, and somebody else takes out a policy in insurance. But in credit default swaps, you can trade them on and on and on. And those were not required to be traded on a licensed exchange. They traded on private exchanges like my firm, GFI Group. We formed that firm, and then we raised private equity. And in 2005, we took the company public. And in 2006, we conducted a secondary offering. We were one of the best performing financial stocks of 2005 and 2006. By 2008, about 80% of the global market for credit default swaps traded on our platform. And in the months leading up to the failure of Lehman Brothers, we heard frequently from the Federal Reserve asking us to repeat over and over again what we did, but also asking us to tell them what we were seeing in the market. And we were telling them weeks before Lehman Brothers failed that Lehman Brothers was a dead man walking. And why was that? Because we knew not only was the ability to insure Lehman Brothers default incredibly expensive, none of the other banks would actually provide that insurance. Because why? Because the wisdom of the crowd was Lehman Brothers couldn't eventually pay their obligations. The marketplace knew before the regulators did that Lehman Brothers was not going to survive. Now, here's the point I want to make. At the time that Lehman Brothers fell, it was calculated by federal regulators that the amount of this type of insurance protection, credit default swaps, written against the failure of Lehman Brothers and held by every other bank on Wall Street was about $400 billion in total. And what they did was they basically extrapolated and said, well, if a failure of Lehman Brothers would trigger $400 billion in payouts, then a failure of Morgan Stanley might trigger $800 billion. and a failure of JP Morgan might trigger 102 trillion. And so they added all that up, and they came up with what they called the TARP program. In the same way that a fire brigade would wet down all the houses surrounding the one on fire so that they wouldn't go on fire, the Federal Reserve said every one of the banks of Wall Street are going to take federal money on its balance sheet so that when there's a run on the banks, they won't collapse. The problem was, we at my firm knew that these banks were reinsuring all of those obligations. That $400 billion of Lehman in what they called the gross notional amount was probably much less on a net basis. And so it seemed to me that this TARP program was way overblown because of the lack of transparency into the actual exposure of the failure of a Lehman Brothers. Well, we now know, thanks to a lot of work done by Professor Bruce Tuckman at NYU Business School, that the net exposure of Lehman Brothers at the time of its collapse was not 400 billion, it was less than 9 billion. If we knew in 2008 that a failure of Lehman Brothers would have only triggered $9 billion of market failure, we could have let it fail. Or we could have bailed it out, the government. Or the government could have put it up for sale. There would have been policy options available that were not available because of the lack of transparency. And here's the point I want to make. It was not longer after the failure of Lehman Brothers that I read the Satoshi Nakamoto white paper that proposed a basically global internet ledger of all the recorded transactions. If all of the exposures of Lehman Brothers had been on a digital ledger, we would have known in real time. And guess what? There wouldn't have been a crisis.
Yeah.
Because we would have had crises caused because of the fog of war. Nobody knows where the real exposure is. If all the exposure was written down on an immutable ledger, we would have known, and we could have taken steps to avoid a crisis. And for me, that was the telling thing. So in 2013, when I was honored by a call from the Obama administration to serve at the CFTC, I saw that as an opportunity to maybe address the failures of the crisis and to implement the Title VII of Dodd-Frank. And in 2017, and I was delighted to be unanimously confirmed by the Senate as the Obama administration's appointment. I was even more pleased in 2017 when President Trump named me as chairman. I was once again unanimously confirmed to serve in that role. So I consider myself very fortunate to have served under two very different administrations. Mm-hmm. But my focus has always been in the health of the markets. And the first thing I did as chairman of the CFTC with bipartisan support was to form Lab CFTC. And we charged it with understanding everything we could about blockchain technology, distributed ledger technology, Bitcoin, Ethereum, et cetera. And that reached such a point that by the third quarter of 2017, this is 7 years ago, we were doing synthetic Bitcoin mining in the chairman's conference room for no other reason that we wanted to fully understand this technology.
What it is. Yeah.
And in December of 2017, we greenlighted the first regulated market for any type of crypto derivative, but more importantly, the first American regulated market for any type of crypto whatsoever, and that was Bitcoin futures. And I'm proud to say that 6.5 years later, that market is deep, it's liquid, it's actively traded, it's transparent, and it's proof that regulators can engage with crypto if they have if they have a mind to do so. And that market is very well regulated.
Is this covered in your book too?
Yes, it is.
Yeah, interesting.
This is my book. And if my book is about anything, it's about the only reason to serve in public life is to take some bold moves and to advance American innovation. It's not to go there and make a lifetime job of it, to go from one Washington job to another. It's to go and serve, and after you're done, get out of the way, which is what I did at the end of my term in 2019. Having served one full term, I left Washington. But since then, I've been very active in all things related to this technology. Why is that? Because I think this notion of putting value on the internet, things of value, who owns what, and who's transferring who to what to whom, on the internet is what this is about. It's a new architecture of finance. We're under the old architecture, the existing architecture today. Value is recorded on the balance sheet of a singular proprietary or government-owned recording, right? My retirement, everything I've saved up, what I look at every so often to determine whether I'm ready to retire or not, whether I can afford to help my kids with graduate school, is not stacks of $100 bills in some bank's vault. It's not stacks of $100 bills in Fidelity's vault. It's an IOU on their balance sheet. If they fail, that retirement money is gone. Now, there may be government insurance, there may be other things, but it exists as a singular obligation of a singular commercial entity. This new architecture has a different value proposition. It says rather than having value exist in one place and one place only, let's record value on the internet, which in 30 years has never gone down. It's accessible day and night, 365. It's accessible by anybody with a computer without having to go through a gatekeeper to get to it. It's a completely new architecture of value, an architecture of finance, an architecture of banking. And it's tremendously challenging to the old architecture, but it's not going away. It cannot be stopped. To think that the internet, the first wave of the internet, that internet of information, that's changed everything we know about how we communicate with one another, right? We used to write letters. We don't write letters anymore. We email, we text. We used to send photographs after we got them back from Kodak in an envelope and share them. Now we take the photograph and send it instantly. It's changed everything we know about shopping, everything we know about how we plan the future. To think that that internet that's changed everything about retail shopping, everything about networking, is not somehow going to change banking and finance and money itself is just naive.
There's a Victor Hugo quote, I think, that just says there's nothing more powerful than an idea whose time has come. And you're absolutely right. It's come. That train has left the station.
Right. And unfortunately, the last people to figure it out seem to be our current generation of regulation.
Is it because they're holding on to their place in the global financial ecosystem? Is that it? Or is it just, I'm at a certain age, a certain point in my career, and I don't want to take my hands off the wheel. I don't want to risk.
You think about it, everything that got them to where they are was the analog 20th century, right?
Yeah.
And to them, this is a technology that can only disrupt everything. And that's across the board. It's not Republican or Democrat. It's more generational. I'll give you another great quote that I like. Adams, blanking on his first name, the author of The Hitchhiker's Guide to the Galaxy.
Oh, yeah.
Douglas Adams, thank you very much. One of my favorite authors has a great quote, and I'm gonna ruin it, but it basically says, anything that's invented before you turn 35 is super cool. It attracts all your interest and very well may be the source of a lifetime career. But anything that comes about after you're 35 is dangerous, it's suspect, and it needs to be suppressed.
Don't trust that anybody over 30, right? It's all in there.
You just summarized the landscape I'm up against as I go out in the world as the a bit of a book thumper of saying, have you heard the good news? Have you heard about blockchain and AI? Have you heard what we can do? I know that we're going to get close on time here, and I want us to be able to switch over to the tables. But while I have you for a quick moment, I want to plug our event that's happening in Santa Monica, October 14th. Which is the day that we shut down Ocean Avenue and Mayor Phil Brock comes out to endorse digital assets plus Santa Monica equals commerce and reestablish themselves as Silicon Beach. There's a lot of things that are happening for our in-person and our stage that we're curating that day. But we do these weekly virtual networkings in order to lead up to the big, important in-person conferences that matter so much in our industry. Those days that everyone will kind of fly in and be in one place and exchange ideas. We've done that for 7 years now, which has led us to say, who's talking to the banks about how they have to wrap their new digital asset infrastructure for what the world actually needs help with? Because I think that the banks are really, let's just say there are polarizing opinions on the topic of banks, depending on what member you ask at what time. But
Christine, hot swap myself out here for a minute.
Oh, yes. Thank you so much for being with us, Heidi.
So I'm going to excuse myself. It's a pleasure talking to everybody at
Hi,
Continuum.
Noah. Thank you so much, Heidi. Hi, Noah.
How do you leave me your card?
Hello.
Hi. Really good segue